Good morning. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly market and economic commentary for the week beginning today, March 24th, 2025. You can follow me intra-week on both LinkedIn and on X. The presentation that you're seeing and or hearing is prepared by me. It is designed for use with you, whether you are a financial advisor or an individual investor. Nothing contained in the presentation should be treated as investment advice, no tax advice, no recommendation for the purchase or sale of any securities. Everything is for informational purposes only. The views expressed herein are mine and mine alone. They may differ from the views of our parent company, affiliates, or other portfolio managers at the firm. A rare all-black week, everything up on the week. Equity markets rebounded from oversold conditions, but somewhat tentatively so. There still remained a significant amount of uncertainty about the implementation of President Trump's April 2nd tariff threats. Later in the week, some of that uncertainty began to wane a little bit. Couple that with oversold technical conditions in the market, we had a strong rally to finish out the week on Friday. Bonds also caught a bid. The aggregate bond index up about 0.5% on the week. Getting into the economic data last week, it was mixed to softening, I would say. The New York State Manufacturing Survey had a big miss, expected to be minus 1.9, came in at minus 20. New orders went from positive to negative. Shipments went from positive to negative. Employment went from negative to more negative. And the outlook fell from modestly positive to less positive. So not particularly great. That was followed up with the Philly Fed survey, though, which told a different story. Philadelphia and New York, for those of you that don't know, are really almost right next to each other. The Philly Fed business survey fell from 18 to 12, but that's still positive, and that was above the expectations of 9.5. New orders fell, remained positive. Shipments down, but positive. Employment rose. So you just kind of say one of these reports offset the other. Not sure how much effect, if any, that will have on the national surveys coming out this week. The early surveys are coming out. The flash surveys are coming out this week, and we'll get the final surveys in about a week from now. We've got retail sales in February up 0.2. The estimate was 0.6. January had been negative 0.9. That was revised lower, minus 1.2. So a disappointment. And then our restatement, which was also a disappointment, made this the biggest drop. The prior January one was the biggest drop since July of 2021. Back on autos and gas, though, and we see a gain for sales of 0.5% after falling about 0.8 the prior month. So mixed report for retail sales. Housing market remains one of the biggest challenges in the economy. The March National Association of Home Builders Housing Sentiment Index fell to 39. The estimate was 42. Anything above 50 says the home builders are getting optimistic. Anything below 50, they're pessimistic. You get below 40, they are, I would call it, highly pessimistic. Present sales dropped, future sales unchanged. Traffic fell to an abysmally low level of 24. Why? Interest rates remain high, costs remain even higher, and construction costs may go higher still with the implementation of tariffs on the inputs of production. Housing starts and permits, mixed story here. Starts were up big, about 11%, but that was just reversing a weather-related January drop of 11%, which just moved out the start date on the January housing. So I would call that a wash. Permits also fell 1.2%, so they're pulling fewer permits. I would call that more of a negative. Capacity utilization and industrial production reported for February. Production gained 0.7, well above the 0.2 estimate. That's on top of a 0.3% gain in January. Capacity utilization rose again from 77.7 to 78.2. I love watching this red line. This is telling me the directionality of inflationary pressures. When it's above 80, we usually say there's high inflationary pressure. Below 80, kind of neutral. And you start getting down to 75, you're getting into a disinflationary, likely disinflationary situation. We're here, we're fine, feels good, we like those numbers. Weekly initial claims for unemployment low. 223,000, right along with the estimate of 224. Continuing claims in this 1.9 range. These are all great numbers. You can see they've been so good for so long. The top of the graph is now only 270. You know, we had weekly millions back during the COVID layoffs and the financial crisis, but 220,000 or 230,000 a week in initial claims for unemployment is really no big deal. Back to residential real estate, existing home sales remain miserably low, even though the rate of sales was up 4% in the month of February, but that is reversing some of the 4.7% weather-related decline in January. A normal, healthy market, 5.5 million homes are changing hands per year in the country. An unreasonably low interest rate environment that's likely to never be reversed. We had it in the 6.5 million range, but we're all the way down here in the 4 million range. Its affordability, in its rates, etc. U.S. Federal Reserve's rate decision, the Fed met last week and they left the Fed funds rate unchanged. I think that was well expected by the marketplace. Now the question is whether or not there'll be one 25 basis point cut for the remainder of this year or two. The median forecast of the dot plot for this year was that we're going to get down to 3.875%. Over the next year, 3.375, 2 years down to 3.125. In the long run is now 3%. So 150 basis points sort of above what they're now saying is the long run equilibrium rate for the Fed funds target rate. They did what I call a baby cut. They didn't cut rates, but they decreased the amount of balance sheet runoff while citing uncertainty around the economic outlook. Balance sheet treasuries, the balance sheet runoff of U.S. treasuries had been running $25 billion a month. In April, they will drop that to $5 billion. So that is a baby cut. Agency runoff will remain at $35 billion. So that's a total of $60 billion a month in runoff, dropping to $40 billion a month in runoff. So it's still deprinting of money, and that's good, but not definitely not a rate cut size move. Markets are now predicting about a 25 basis point cut by July 3rd, with a 50-50. It could happen earlier, June 18th. I think it all depends on what's happening in the markets, and a total of 50 by the end of the year. Although I saw a news alert this morning, Raphael Bostic said, no, I don't think it's going to be 50. I think we'll get 25 in this year. And it's all because inflation continues to remain hot and well above the Fed's target rate. So why we're having a big risk on rally today. Everything from stocks to crypto is rallying up. Volatility is down because last night on Sunday, the Wall Street Journal reported that the Trump administration is scaling back the April 2 tariff promises. Instead, they said we're not going to do these across the board reciprocal tariffs for now. We will instead focus on targeting nations that account for the bulk of the U.S. international trade, who they are now referring to as the Dirty 15. And these Dirty 15 countries are the bulk or the preponderance of the trade imbalances, but they didn't name them specifically, as I think negotiations are ongoing. So the market saw that as progress. This now has become a trade, right? President rattles his tariff saber aggressively through either himself or his surrogates. Then markets go risk off. Then he backs off, right? This was used, we've seen this now twice with Canada and Mexico. We're now starting to see it with some of the bigger European and Asian partners as well. Plenty of economic data this week. We're getting the flash readings this morning from S&P Global on both manufacturing and services. House price data on Tuesday for Case-Shiller and FHFA, along with home sales, consumer confidence, durable goods on Wednesday. Jobs claims, fourth quarter GDP expected to be up a tick from 2.3 to 2.4, pending home sales, income, and spending. But it all comes down to Friday. It's PCE inflation. That's the gauge that the Fed uses to determine whether or not they're meeting their statutory mandate of price stability. Expected to come in at 0.3% on the month. You compound that for 12 months. The results are not good. They are not at 2%. So if the number comes in below 0.3, remember we had the surprise beat on PPI and CPI, especially PPI 2 weeks ago. If that happens, the market could continue to rally. If it comes in above the 3.3%, you can expect a sell-off because it will push out any future Fed rate cuts. Thanks for tuning in, everybody, to Slaying Bulls and Bears. My job is to make the complex and complicated as simple and sensical as I possibly can. This is also available in addition to being on YouTube with the video, best place to watch it, but on all the Apple and other podcast formats as well. I thank you for tuning in, and I'll be back to you again a week from today.